Let's get more now from our special series, Life After Lehman. 10 years after the lender fell, the banking space has changed drastically. Anshu Jain witnessed these changes firsthand. He's the president of Cantor Fitzgerald and the former co-CEO of Deutsche Bank. He spoke to our Erik Schatzker.
First thing which I would point to is the fact that banking today is dominated by the behemoths. And now that perhaps is an unintended consequence, but when you set the minimum standards of capital that high, inevitably what wound up happening is that a few firms have tended to dominate wholesale banking, almost all of them American. So those are the two things which I would say are different today versus a decade ago.
You get $3 trillion balance sheets.
You get $3 trillion balance sheets, and you can say there's $1 trillion market cap companies now which didn't exist back then. So one end of finance is completely dominated by those behemoths today, okay, with all that's good and all that could be concerning about it. The second thing is price discovery at the margin, Erik, is being done by the central banks. So you've got both these things happening at the same time. You have banks being categorized as regulated utilities. Who's the marginal price setter for credit? In Europe today, it's the ECB. For the longest time in the US, where mortgages were priced was driven by the bond buying program. Pivot, flatten the curve, tighten spreads. Now, that is ebbing away finally in the US, will happen in Europe, and will happen globally. Banks and financial institutions generally need to come back into that price setting mode for the system to work in a more true price discovery fashion.
Are banks the ones to end up doing that price setting? And I ask that question for two reasons. On the one hand, they're highly regulated institutions that in many respects behave like utilities now. Secondly, the non-bank securities industry used to perform that function before 2008, and it's gone. Merrill's gone, Bear Stearns is gone, Lehman is gone, as we know. Goldman Sachs and Morgan Stanley are banks.
So that's a very interesting question. No doubt that banks were setting the marginal price of risk, perhaps overly so between 2004 and 2007. No one wants to go back to that again. You're making a separate but related point that the broker-dealer model, which I grew up with, I made my debut at a firm called Kidder Peabody, which no longer exists. So middle-sized firms which were dynamic, very client-focused, but wholesale funded, defined Wall Street back then. It wasn't JP Morgan and Citibank. It was Goldman, Solomon, Morgan Stanley. The firmament of the top players were those firms. Now, what's happened post the crisis is you have in the investment banking corporate finance space, the hyper boutique, which has done very well. I believe there is room for the more middle-sized, not all things to all people, nimble organizations, and I think you will see some of that.
And that's, in effect, what you're doing now with Howard Lutnick at Cantor Fitzgerald, trying to build a firm of that nature, are you not?
There's many firms that will try and occupy that space. Yes, I mean, Cantor has always been in that space, and we're hoping to expand what we do.
Do you worry at all, Anshu, about the risk that is once again building up off of bank balance sheets in private credit, for example, and elsewhere beyond the purview of regulators?
So, Erik, the first thing which I would point out to you is the banks are in good shape. Okay, I know there'll still be debate around it. We've acknowledged the fact that we have behemoths, but these are well-run, highly regulated, well-capitalized, stable-funded behemoths. Mm-hmm. So when the banks are in good shape, you have a stable anchor in one corner of the market. Now, have we had imbalances? Well, there's been lots of places of rapid growth. Some intended, some unintended consequences of the last 10 years. As the banks have shrunk their role, other firms have stepped in. As QE has prevailed, those low interest rates have produced flows of capital out of certain sectors into other sectors. And we know what many of those are. The concern that I would have is if the holding capacity of the firms or funds which hold those big assets is not stable, which is what we had in 07-08, and I don't see that. So if we're talking about the ETF industry, we talk about closed-end mutual funds, retail, certain aspects of that world, which is where the assets are accumulated. You can say there's been very rapid growth. We should watch it all closely. How will they behave if valuations change? But I don't see an analogy to 2008.
Where do you think the locus of the next crisis will be?
Impossible to call. I would certainly say the things which I've traditionally looked at don't concern me as much. Sovereign balance sheets have to be looked at. So if you ask me to hone in, and not necessarily emerging markets.
You're not the only one to say that it may be a sovereign debt crisis. That's a reality as plain as day.
You have many more tools to deal with a sovereign debt crisis. 2008 was what it was because there was no playbook. There is a playbook. It's not the most pleasant one.